And my ID number is AC0102291.
My name is Fariha binti Zulkifli. My ID number is AC0102947.
Management accounting information is produced too late, too aggregate, and too distorted to be relevant managers' planning and control decision. Consequently, first, management accounting reporting are little help of operation managers attempting to reduce costs and improve productivity. Managers spend time trying to understand and explain reported variants that have little to do with the economic and technological. Management accounting systems do not provide timely and detailed information. Secondly, the management accounting system fail to provide accurate product costs. Costs get distributed to product by symplectic measure, usually direct labor base, that do not represent the demands by each product on the firm resources. Thirdly, managers horizon contract to the short-term cycle of their monthly profit and loss statement. Short-term profit pressures can lead to decrease in investment for the long run. Today's management accounting system provide a misleading target for managerial attention, fail to provide relevant set of measures that appropriately reflect the technology, product, processes, and competitive environment in which the organization operates. So that's the organization management accounting system must provide timely and accurate information to facilitate effort to control costs, to measure and improve productivity, and devise improved production process. The management accounting system also needs to report accurate product costs so that pricing decision, introduction of a new product, abandonment of obsolete product, and responses to the appearance of rival products can be made with the best possible information. With the incentive that we give them, large decentralized organization require system to motivate and evaluate the performance of their managers. Secondly, vital two-way communication link between senior and subordinate managers, which senior executives communicate to subordinate and decentralized managers the goals and objectives of the organization. However, an effective management accounting system can undermine even the best effort in product development, process improvement, and marketing policies. With an effective management accounting system, the best outcome occurs when managers understand the irrelevance of their system and bypass it by developing personal information system. I will explain you about the opportunity. Unfortunately, the increased demand for excellent management accounting system occurs at a time when the cost for collecting, processing, analyzing, and reporting information have been decreased. Today, designer of management accounting system can be sophisticated electronic technology to devise reporting and control system that are more accurate, more timely, and hence more effective than those designed by their predecessors.
Okay, I will explain to you about the management accounting's role. Historians have demonstrated that accounting reports have been prepared for thousands of years. Bookkeeping records dating back to ancient civilizations have been found engraved in stone tablets. Before the early 19th century, virtually all exchange transactions occurred between an owner, which is entrepreneur, and individuals who were not part of the organization, which is raw material suppliers, labor paid by piecework, and customers. Transactions occurred in the market and measures of success were easily obtained. The owner or entrepreneur needed to collect more cash from sales to customers than was paid out to suppliers of the input factors of production, primarily labor and material. The early management accounting measures were simple but seemed to serve well the needs of owners and managers. They focused on conversion costs and produced summary measures such as cost per hour and cost per pound produced for each process for each worker. These enterprises could now coordinate the acquisition of raw materials and the distribution of final products over much larger geographical areas than had previously been possible. In fact, effective management accounting systems were necessary to coordinate efficiently the logistical, conversion and distribution activities of these enterprises and to provide summary measures of performance for decentralized and dispersed managers. The operating ratio, the ratio of revenues to operating costs, was developed, both to measure the profitability of various segments of business, passenger versus freight, region by region, and to evaluate the performance of managers. Obviously, measures of conversion costs, such as cost per hour or cost per pound, or the operating measures of the railroads, the cost per ton mile, were not relevant for these distribution enterprises. The management accounting measures were designed to motivate and evaluate the efficiency of internal processes. There was little concern with measuring the overall profit of the enterprise. These organizations really had only one activity that had to do well: convert raw materials into a single final product. A number of important operating and budgeting activities were devised by the senior managers of DuPont to coordinate the activities of their diverse operating groups. Only top managers used ROI to help direct their allocations of capital and to evaluate the performance of the operating department, which could be different from the performance of the manager of that department. Donaldson Brown, the Chief Financial Officer of DuPont, decomposed the ROI measure into its component parts and demonstrated that the ROI measure could be viewed as a combination of two efficiency measures: the operating ratio, return on sales, and stock turn, sales to asset, used by single activity organizations. Next, I will proceed to the new point, which is lost relevance. By 1925, virtually all management accounting practices that are practiced today had been developed. Cost accounts for labor, material, and overhead, budgets for cash, income, and capital, flexible budgets, sales forecasts, standard costs, variance analysis, transfer prices, and divisional performance measures. Even without significant innovations in organizational forms, however, the diversity of products and complexity of manufacturing processes continued to increase in the decades after 1920. Thus, the need for accurate product cost and effective process control should have imposed new demands on organizations' management accounting systems. Yet, the evolution of management accounting systems after 1920 did not keep pace with the improvement in corporations' product and process technologies. This lag eventually led to today's problems: distorted product costs, delay, and overly aggregated process control information, and short-term performance measures that do not reflect the increases or decreases in the organization's economic position. Perhaps the product line of 1920s organizations was more focused than that of today's organizations, so that the distorting effect from using simplistic methods to attach cost to products was not as severe as it has become today. Also, the cost of collecting data and providing prompt reports to production managers may have been too high to permit the real-time process control that is now possible. Over the years, however, as corporations' product lines expanded, as production technology changed, as product life cycles shortened, as global competitive conditions shifted, and most importantly, as great advances in information technology occurred, we should have expected a reconsideration of the decision to not invest in a more relevant and more timely management accounting system. In fact, when cost systems became automated on digital computers, starting in the mid-1960s, the system designers basically automated the manual systems they found in the factory. Left unquestioned was whether these systems were still sensible given the great expansion in information technology represented by electronic digital computers. Okay, next I will explain to you about the academics led astray. We believe academics were led astray by focusing too narrowly on a simplified model of firm behavior, influenced strongly by economists' one production process model of the firm. Management accounting academics found little value in the cost allocations imposed on organizations by financial accounting procedures. Succeeding decades, however, chief executives were selected whose entire careers were spent in staff functions, such as finance and legal. Lacking knowledge and uncomfortable with their firm's underlying technology, these CEOs increasingly looked at what the projected short-term impact would be on financial measures when making decisions, especially earnings per share and return on investment. But as product life cycles are shortened and more costs are incurred before production begins, which is research and development, product and process design, capital investment, software development, and education and training, directly traceable product costs become a much lower fraction of total cost. Consequently, traditional financial measures such as periodic earnings and accounting ROI become less useful measures of corporate performance.
For caravans. This phenomenon was started in Venice, where the merchants in Venice were trading goods with other countries. For example, they sold goods in India and the traders purchased tea from the Indian merchant. Then they sold the tea in Venice. At the end of the expedition, the accountants subtracted the cost of caravan and the cost of acquiring the initial lot of merchandise from the revenue received from the sale of tea in Italy to compute the profit for the entire trip. A profit to be distributed among the investors in the venture. And did the investor or the Venetian compute the expedition's profit during the third quarter of 1487 when the caravan was traversing the Persian desert en route to India? Probably not. Because even in the early unsophisticated days of accounting, investors understood that allocating the total profits of expedition to periods as short as 3 months was not meaningful exercise. But there are probably many measures of the caravan performance during the third quarter of 1487 that the investor would be interested in knowing. For example, what distance did the caravan cover and in what direction? How many provisions are left? What is the condition of the investor during being transported. Are the workers content or rebellious? There are many potential useful indicators of the caravan manager's performance during the third quarter 1487, but quarterly profit is not one of them. And given the current competitive technologically environment, there are probably many better indicators of a company's short-term performance than its quarterly earnings. Certainly, cash flow is important, and we would want to know the pattern and structure of a company cash receipt. But knowing source and use of cash is very different from working hard every month and every quarter to produce complete income statement and balance sheets, replete with amortization, capitalization, and many other accruals. Needed innovation. Management accounting system can and should be designed to support the operation and strategy of the organization. The technology exists to implement systems radically different from those being used today. What is lacking is knowledge, but this knowledge can emerge from experimentation and communication. The innovative spirit of 100 years ago at the outset of the scientific management movement can be recaptured by creative manager and academic researcher who are committed to developing the new concept for designing relevant management accounting system.